The current pic.
Hello. Let's go. Okay, we got live call here
The current pic.
from Chrome. Let's check this out. Boom. Let's go. Okay, we got live call here
The current pic.
from Chrome. Let's check this out. Boom. Let's go. Okay, we got live call here. We're missing it. There we go.
In the first quarter, as
Let's check
unusually
this
sharp
out.
swings in inventories and net exports more than offset
Let's go.
continued strong underlying
We got
demand.
live call
Recent
here.
indicators suggest that real
We're
GDP
missing
growth has
it.
picked
We're
up this
missing it.
quarter,
There-
with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor
Okay.
market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust.
They always tout this
Improvements in
labor
labor
market,
market
right?
conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January.
That's going to
FOMC
change here in the next
participants
2 months.
expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April,
Yeah.
total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the consumer price index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation.
Yep.
And
Seen that.
COVID-related lockdowns in China are likely to exacerbate supply chain disruptions.
How does this guy not have just wrinkles everywhere
FOMC
after this
participants
year?
have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and
How are they gonna-
2.2%
how are you getting that?
2024.
In 2024.
Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices.
They
for
already
the
raised
American
75
people.
basis points. If you guys didn't see
My
that earlier.
colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year.
So they've been up
The committee reiterated that it
1.5%.
anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
And they want to reduce the balance sheet. Interesting.
Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value.
So they've upped everything, hey?
The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
I love how they're surprised by this inflation. Just it's surprising to all these people.
Incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy.
We're 6 months into recession.
We understand that our actions affect communities, families, and businesses across the country.
They're going to raise rates into a recession.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Jerome Powell's a good looking dude, I'll tell you that much. They're raising rates. So you guys just hopped on 7.
Two questions, Chair Powell. Did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense you can of what role you played in reshaping market expectations so quickly on Monday?
Yeah, it's a great question. Like, why are you guys so off? How'd you guys miss so bad, right?
As you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent. And so,
So what's interesting, I'm
That's what we
gonna come
generally
in
think
here for a
about
second.
guidance,
What's
and that's-
interesting is they are raising rates, right? 75, which they needed to do, right? You have to, their goal is, there's a lot of tough talk on inflation, and they're saying inflation's our number one goal, number one thing we're gonna do. And, you know, they have, now it's interesting, past recessions or past depressions, we've had tools, a safety net of bailouts from the Fed. This time we don't have that. They are already put rates to zero. We are raising rates into a recession right now. We're in about, I think about 3 weeks, we're going to announce we're actually in a recession. It takes 2 quarters of negative GDP growth. We've already had one. We're looking like we have a second right now. What do you know, you're going to raise rates into a recession. They've already said they don't care about the stock market. They just want to fight inflation, which is anyways interesting.
so we decided we needed to go ahead. And so we did. And that's really how we made the decision.
Sounds like, and they're going to do another 50 to 75% next meeting, in July, next month.
Thanks for taking our question. Gina Smirlik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today, what did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned.
Now, here's the thing too, is inflation's CPI is a year over year number. It's a 12-month number. So, you know, it's up right now. July, August is when it really started ticking up. Once we hit August, it's going to go down regardless. It doesn't mean real inflation has gone away though. Just if the CPI goes down, everyone's like, yeah, inflation's going away. No, it's not. It's just the 12-month trailing has gone down. The cost of groceries is still high. It's still up there. It's not like it came down. It's just still high. It's just not high for the last 12 months.
Over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels. And we came to the view that we'd like to do a little more front end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, you know, in that range in that more normal range. And that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And, you know, so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show result, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case,
and he keeps using uncertainty. We just don't know. We were surprised by the inflation numbers. We were surprised that it wasn't transitory like we thought last year. I mean, how could you not see this wasn't transitory? We've been saying this for a year. Maybe they saw it, they just didn't want to admit it. Maybe they liked having this free monetary policy juice in their markets. And maybe this is, anyways, we get in other theories as well. I believe the Fed are very smart people. And oftentimes what they tell you isn't actually what they're doing, just in my opinion. Let's go for the next question.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Great question.
Sure. So the question
Yeah, great
really
question.
is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of
What he means is the
financial
yield of
conditions.
a treasury bond is less than
I have to look
the
at it
rate of
this way.
inflation, right? So it's a
We move
negative
the
yield.
policy rate. That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our
It's funny,
policy
they
tools.
keep touting this red hot labor market, this red hot
those would be,
economy.
things
It's
that are
economy
the
built up
commodity
though
price issues
on
that we're having
borrowed
in
money,
the
right? On
world,
cheap
in
capital.
Ukraine and,
Consumer credit jumped. I think it was like 46
and the
billion
fallout from that,
last
and also
month.
just the whole supply side.
This
things
is
are still,
our economy's already
pushing
had a
upward
negative
on inflation.
negative
So
percentage
that's really
Q1.
how-
I think
how
Q2 we're gonna see
I
the
would
same
think about
thing. I just hate how they keep touting this red hot economy. He's asking, does it get the job done
I think
to get
it's
inflation down?
certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're gonna find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
Good question. Like,
So,
why did you guys
if
miss
you
so
look at
bad?
You look at a broad range of
Why are
inflation
you guys
expectations.
so off on your previous
you've got
statements?
The public,
love it.
you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that
They're
the
just
index of
constantly
inflation expectations
surprised.
at the
Just-
board has moved up. after
We are
being
surprised
pretty
by
flat
what's
for a long
going on.
time.
We
So
just
we're watching
can't
that, and we're
believe
thinking,
you
this is
inject the
something we need to
economy
take
with
seriously. And that is
trillions and
one of the
trillions of
factors,
dollars.
as I mentioned, one of the factors in
we have
our
no idea.
deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be.
This guy's
The
hitting
main
them.
thing
Nick's
is to
hitting them hard, man.
get rates up.
You guys missed. You're
And-
off
and then
before. How do we know
pretty
you're not
soon we'll
off
be in an
today?
area where
Right.
we're
Markets
I
right
think
now
as you get
recovering
closer to the
strong.
end of the
Nasdaq
year,
up
you'll be in a range
just under
where
3% for the day.
restrictive
S&P up
policy, which is
1.8%.
40
Gold up
housing inflation,
1.5. A lot of
housing
confidence in the
policies
market.
may be
Tesla up
restrictive.
5% today.
And
Apple
we're
up
gonna have
2.
restrictive. So
Silver up 3. Nvidia up 5. Amazon up 5%. So strong recovery after just getting beaten the last few days.
Thanks for taking our questions. The late breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off because you have to live with that guidance. And so you do it and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out. And that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react.
We haven't seen progress since November. We've been talking about it since November.
Progress at some point.
Since last November, said, man, inflation's a problem. They haven't done anything.
But I would like to think
until the beginning of the year. They started to raise rates
is still
a
credible,
titch.
but it's
They
always going to
just
be conditional
started
on what
bond
happens.
buybacks.
This is an unusual situation
Right
today.
now, issuing bonds at, I think it's 80, is it 60 or 80 billion a month? They just started in June. Took them 6 months to do that. I mean,
very unusual.
these questions are spot on. It's Jerome Powell. We're looking to you for direction as a Fed chair. And he's saying, well, we just don't know. We're going to try to get inflation down. We're going to decide next meeting. We think this is appropriate for right now because the Fed's hands are tied. That we've been saying this for months and months. They are tied. What else can they do besides raise rates? And they, hindsight's 2020, but anyways.
Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
So the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings
Kind of
for inflation.
A similar question.
And we
Yeah.
want to see-
I mean, there's a lot of tough talk here on inflation, right? That's what they are saying. Our goal is to curb inflation. I mean, their ultimate goal is to protect the US dollar, right? They are here to protect the US dollar in whatever way, shape, and form they can. Right now, that is the biggest thing is inflation, right? They're fighting inflation. That's hitting, you have $10 a gallon in California. I just saw one area of California, $10 a gallon. you know, you're seeing huge energy spikes, food spikes, everything spikes, and America is mad about it, especially during a election year, right? You see the primaries starting to happen right now, and a lot of incumbents, their seats are up and they are shaking in their boots right now. You wonder if there's a big political play here, you know, pressure. And I think they felt that pressure. My opinion is the Fed felt that pressure strongly from, let's just call it the current administration, the Biden administration and the Trump administration during their time period when they're in. And now it's too late. I think Jerome Powell said he's finally just saying, like, screw it. I'm not going to listen to, you know, a president or someone else. We got to do what's best to curb right now. What they're saying is inflation. You know, you had this 2 years of zero rates. So
to bring down inflation, it's going to require more than just some pain at this point.
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path, there's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces. And that path is to move demand down. And you have a lot of surplus demand take, for example, in the labor market.
And they keep touting this
job vacancies essentially for every
strong labor market
actively seeking a job. And that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity.
So it's interesting about the labor market. I'm gonna chime in here for a second. You know, he just said there's two spots open for every job available, which, you know, when you're negotiating a salary, right, people are in high demand. And so you can negotiate higher, hence, you know, you have this inflation of wages and salaries going up. Why don't I don't know why this hasn't changed. Trump with COVID, they essentially closed borders. They said, no one's coming in here, immigrants. Biden has just kept that policy. I thought Biden came in as this, you know, the southern border, all this stuff for legal immigrants. They all want to come to the United States around the world. I've traveled to a lot of countries around the world. I lived in Taiwan for 2 years. They all want to come to the United States. Why don't we let the best and brightest that are applying right now in droves to come to the United States? Why don't we let them in? Come fill these jobs. Me and all my friends, we have multiple job openings in our companies. I think right now we have 4 or 5 job openings at IFS right now. I mean, let them in, let good people from other countries come in and fill this labor market and boost our economy. I feel like that's like the answer that we're all looking for. Man, we don't have anybody filling jobs, and essentially companies can't grow without the right headcount. Like, what's going on?
The unemployment rate has to go up and people lose their jobs in order to control inflation. Thank you.
So
doesn't unemployment have to go up? People have to lose their jobs.
We have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, you know, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. You know, we hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
So, I mean, essentially saying he's saying, man, our economy, we are
Again, we're not
going into a recession. We're headed into a recession. What is happening right now? We are headed for stagflation. Stagflation is increasing inflation with decreasing economic growth, meaning companies are going under, going bankrupt, firing employees. We're having economic decline, less total output of an economy, while at the same time, inflation is still up. That's one of the worst scenarios you can possibly have in economics. We are, I mean, I'm no expert here, but that's where we're in right now. We have a decreasing economy with a rising inflation.
Where there's lots of job opportunities, where it's just a really, I mean, the labor market we had before the pandemic that's what we want to get back to. And you see,
I know that labor market
disparities between various groups at
with Trump,
lows.
man. I mean, Trump really did a great job with that. He did an incredible job with the economy and bringing in a really strong labor market, and economic output was soaring. Right.
It really is
COVID hit. Anyways, obviously the whole COVID thing. And now, I mean, why don't we get back to that? Why don't we reopen borders and allow people to immigrate and fill those jobs? At least let companies that are trying to create economic output have people there to do it.
With Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple of years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
You're not trying to induce a recession now. Let's be clear about that.
We're in a recession.
Trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in, prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate. So we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for, such reduced confidence against, say, a month ago or 3 months ago, that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more.
So they keep touting, so we're talking about supply side inflation. So what they're saying is essentially because there's more people that are demanding a single good, and because goods, there's no supply chain that, it's harder to get an iPhone or AirPods or whatever, that more people are bidding on those products. Hence you have inflation. It's not just because there's more dollars, it's because there's less things, supply side, not demand side, supply side inflation. Now this is true. That's happening. They keep touting Ukraine war. I also think you see the boats in Shanghai, right? You see there's the Shanghai port I think has like 2,000 boats waiting to be shipped. I mean, they're not shipping anything out of Shanghai. Shanghai was put on lockdown the last 2 months. They're still in lockdown in China. I don't know why they're still in lockdown. Anyways, that's a huge problem, supply chain issue. And Jerome Powell saying, hey, maybe that's the issue. And he could be right there. We're having a really hard time with supply chains, and there's just less goods to bid on, right? People are still like used car market is still high because new cars it's hard to get here, right? You go order a new Tesla or a new Hummer or whatever, they're 12 to 18 months out. That's kind of what they're touting there for supply side inflation. That's also hitting now real inflation. Now, the other problem is that they've printed so many dollars that people have so many dollars that they're willing to bid on kind of luxury items, right? They're willing to bid up Rolexes and cars and other houses and other stuff that, are needed to be purchased. And in addition to supply side inflation goes drastically down when you don't have as many dollars though as well.
Consumers slowing spending or changing their habits.
So we're of course watching very, very carefully for that. And,
So asking about
looking at the
consumer
retail
spending,
sales, the big store
numbers.
numbers and all that kind of thing. And so but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things the sales going down, but overall spending is very strong. The consumer is in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing.
What about
a bit,
consumer
but
spending
still
though, going through the
growth
roof?
levels?
People are
healthy growth levels.
still buying, but they're just buying on credit
Are
cards.
raising rates in this economy? How closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit. We're responsible for watching everything, but consumption is 60% of the economy, 2/3 of the economy. So naturally we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Can I just, as a follow-up, get a clarification on the SEP when the members
So they're dedicated
their
to headline
forecasts?
inflation.
When
That's
were
what we
they
said,
inserted
point blank.
into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Victoria. Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports. And I guess I'm curious whether you think inflation data itself is a really good indicator, or whether, you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there's sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
All right. Well,
So
kind of a bad question. He's already talked about that. So, interesting. We'll see. I'll say this again. I think their hands are tied. They have to raise rates into a recession. We'll see. I believe by their next meeting in July, we will be in a recession. We will be in a recession, and it's gonna be a different conversation, especially from headline news pushing on, hey, we're in a recession. What are we gonna do? We're gonna really raise rates in a recession, which there sounds like they are planning to do. There are a lot of tough talk on curbing inflation. Now, I think regardless of what they do, inflation is going to come down August, because it's a year-over-year number. It's a 12-month trailing number. And so what could happen is they say inflation is going to come down, or inflation's coming down. It's worked. What we're doing is working. Let's pause rate hikes. So I think July meeting they could raise. I think in the fall, I don't see them. I mean, we're going to be in a significant recession, I believe, in the fall. And I think they're going to say, hey, inflation is leveled or come down a little bit, because just the nature of a year over year number. And we're going to pause raising rates in the fall. That's me live on YouTube saying that. You guys are going to come back in 6 months from now and say, wow, Bridger was, let's see if I was right or wrong. But that's where I think they're going to happen. What else are you going to do, right? What else are you going to do? You're going to really raise rates again in a recession and push more economic downturn, especially, months before a midterm election. I think, I don't know. I think it's gonna be hard to do. That's my commentary on it.
The public generally sees us as very likely to be successful in getting inflation down to 2%. And that's critical. It's absolutely key to the whole thing.
So just a lot of tough talk on inflation. Man, these guys have it's been interesting in the last 2 years. Let's do this next question.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like, you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the question, really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and we'll use them and they do work.
So we're going to make sure, the public has confidence. We're going to be, and then back to their, I think probably most of the questions will be the same. So again, that's what I'm saying. I think the Fed has their hands tied right now. We've been saying this for months and months and months. It's the only thing they can do, right? Is they have to curb inflation. They need to get back to a normal level. Now, the nice thing about the Fed, and now let's say the US dollar, our inflation numbers are significantly, well, not significantly, but there's a lot of other countries with worse inflation. Britain is at 9%. A lot of Europe is around or above 10% inflation. We're bad, but other currencies are just as bad. I mean, most of the world is inflating their currencies from COVID and feeling the effects of inflation around the globe. I think oftentimes we just look at the US. This is, I would call us the tallest midget at the circus, right? We are in a spot right now where, things are bad, but it's also pretty bad other places too. You're seeing huge economic strains on pretty much the entire world right now. So we will see. we'll see what happens. The Fed's, raising rates 75 basis points today, looking like to do another 50 to 75 basis points in July. I think by August, inflation will be year over year inflation. CPI will be at least flattened, if not going down. And they're going to, we're going to be in the midst of a deep recession. Personally, I think that's what we're going to be. I think we're going to announce this recession in probably 3 weeks once the July numbers hit. And we're going to be in a recession. I think it's going to be very unpopular for them to raise rates through a recession to their actual target that they're putting out there. Now they want markets to price in that target of, 3 3.75 or about around 4%. But I personally don't think they're going to hit that. We haven't hit that number in, over a decade. And I just don't see them hitting that. So it's my opinion. You guys are awesome. Thank you.